Peter McGuire, CEO of XM Australia. Peter, that's in essence, at least on the surface of it, one of the big unknowns that this market was stuck in limbo about what the Israeli retaliation would look like. Would it hit the oil infrastructure and disrupt Iranian supplies, etc.? That now seems to be taken off the table, at least for the foreseeable future. The same thing happened 6 to 7 months ago in April when Iran and Israel had a similar face-off. Now we go to the next sort of unknown with the US election. And ironically, one of the great potential outcomes of the US election, i.e., if Trump wins, could be the shutting in of Iran production. So we're all jubilation today that the Iran oil production, or jubilation in the essence that it didn't escalate into that space. Now the next big unknown is whether Trump does it, not the Israelis. Your thoughts?
Well, yes, I mean, a week out, and just for the volatility today, building on what Omar said, Sean, and hello to everyone from Sydney. Great to be here. When you see this market 4.5% down, spanked down heavily, I didn't expect that to happen. I know as far as the telegraphing of it and I think the framework that was put across as far as, the intention and how it was perceived and all of that, but I didn't expect the market to wash out as violently as what we've seen in, the last 6 or 7 hours of trade. Is just quite very surprising. So where does it roll? Well, we're 8 days away. You've got big numbers. You heard Joe Rogan, and if anyone watched it, and President Trump over the weekend, 33 million viewers. It's gaining momentum.
Had clearly nothing else to do. Clearly had a very big gap in their schedule to listen
yes.
to the red-headed babbler.
Yeah, and you've got to say we're 8 days out. I'm not sure how it's going to roll as far as what his intentions are going to be, where the marketplace is going to be, if he is elected, if he isn't elected. All of these factors are going to be worked through, and then naturally what impact that has to the drill baby drill agenda. Is he going to add the tariffs are going to be as aggressive as what he states, Sean? There are just so many components to this, or moving parts, that it's hard to digest. All I know is this: you've got an equity market fully priced. You've got a US dollar going through the roof at 104.50. You've got the yen being sold off. They have an election over the weekend, and the yen gets cratered, and the stock market's up 1.8%, the Nikkei today. So, it seems to be that momentum. We've got a big week of data, Sean. We've got non-farm payrolls on Friday evening.
Peter, the other news that happened over the weekend that got somewhat smothered by the news of Iran Israel was the China's industrial firms data came out for their performance in September, and they declined. Profits declined at a faster rate than the previous month, and year on year down a whopping 27%. Industrial profits at China's largest companies down year on year 27%. That's a big number. I mean, if that was a publicly listed company in the US stock market, it would fall off a cliff. What is this telling us about this China stimulus versus what seems to be a continuous conveyor belt of weak data?
Well, Sean, I think it comes down to a China debt bubble, and we all understand that. And I mean, the numbers you hear are frightening. And when you realize that the debt to GDP, China debt to GDP is in a jaw dropping 366% in Q1 2024. Now, that's double the ratio that you saw in 2008, Sean. That's catastrophic. And for every unit of GDP that they produce, the Chinese economy achieves debt burden of 3.66 units. So that gives us some sort of an idea. You're really behind the curve. How do you get through there? You've got deflation. You've got the non-financial corporates have the highest ratio at 171%, followed by the government sector at 86%. So this is the issue that they face. You've got that overhang as far as property. How do you deal out of this? Deflationary, stagflation, and it just seems to be going one-way traffic. Who's holding the debt, and how does that get played into the debt holders and bondholders? Where does that all end up? So I think it's going to be 25 is going to be a very interesting year for this to all be examined.
Peter, just picking up on that point, I mean, this is where this sort of current era of oil supply cuts and oil market management started 4+ years ago in March, April 2020, when Russia and Saudi allowed a lot of daylight to come between their positions, and there was a very public falling out, and then they came back together again quite quickly, mainly driven by the very dramatic events of COVID, but nonetheless
Yes.
they came together for to manage the oil producers' way through COVID and thereafter, and did a pretty good job from the oil producers' point of view. Where do you think that's at now, picking up on the points that Omar's making there, sunlight between them?
Well, I think, Sean, I mean, when you're quoting the sort of numbers that Omar's suggesting, $50 Brent or $50 WTI, there's a big sell-off that we're going to experience in the short to medium term, if that's to materialize. So there's the first part. Is there going to be an end to any further geopolitical concerns, which did give a premium to price? And we understand that that washes out very quickly. So is it all over as far as Iran and Israel now, or is it completely finished, or is this only a starting point? I think there are just so many different frames that need to be considered in all of this argument. Yes, you've got supply and you've got the OPEC considerations and Russia. We understand the fragility, as Bill highlighted, with, is China going to be a play out Japan version 2, and it's going to take a decade or two to wash through? And what's going to happen there as far as consumption? You've got a new player entering the market, could it be President Trump if he is elected, and the impact that has to the energy concerns, certainly in America, and then becoming an energy powerhouse and exporting. So all of these frameworks need to be, again, you're sitting up here and looking down, but going, wow, it's very difficult to even fathom. If you were to strip 40% out of the energy markets at the moment, price-wise, and we say they won't take action on that, I find that it just doesn't hit me between the eyes, that one. I'm a little bit like, wow. I think there'd be action from OPEC and the producers. I think they cut production dramatically to keep price at those sort of $60+.
Peter, just on that point, just closing out quickly, the idea that the divergence, or will there be in this softening cycle, the U.S. Fed big cut at first, the Europeans, Japanese, the Brits. Do we see a divergence here? The Americans may back away, the others will keep surging ahead, strengthening the dollar further. Your thoughts on the outlook for that divergence?
Well, Sean, is the 25 basis points baked in on the 7th of November? I think the jury's still out. There's probably 50, 60%. Yes, it's going to happen. But the argument is now coming with, as far as non-farm payrolls last month at 245,000, they're tipping 140,000 this Friday. So you'll get the number. We understand what's happening as far as GDP. 3%. The Atlanta Fed model's saying 3.4%. You could shoot that out, Sean, with better numbers even this week. You've got the growth of the Magnificent Seven. The numbers coming out there could be startling. We've got 4 or 5 of them. I think 5 of them are announcing numbers in the next 72 hours. So all of that factored in, Sean. Are we going to see a capitulation of equities? Should Trump get in? Are we going to see the Fed not cut rates, which in turn would, I think, put pressure onto the equity markets? And what happens to the likes of gold and silver and, that return as far as, from a risk perspective? Is that where the money's going to, I suppose, look at in the sense of how much they've printed in the last year? All I know is it's going to be volatile, I think, in the lead up to Christmas.